Bloomberg Audio Studios. Podcasts, radio, news.
This is Wall Street Week. I'm David Westin, bringing you stories of capitalism. This week, why families from Las Vegas to Vancouver can't afford to buy a house. If you can buy the house, why you may not be able to afford to insure it, particularly if you live in Florida or in California. And U.S. ports are consistently ranked among the least efficient in the world. What sort of investment would it take to fix that? But we start with the story about that trade balance President-elect Trump focuses on so intently. On Thursday, we got the numbers which once again showed the U.S. in the red. But what does that tell us about the economy? And is restoring the balance, as Mr. Trump insists, really so important? Here's Bloomberg International Economics and Policy correspondent Michael McKee.
There is a story about a college professor who told his economics students anyone who used the term bilateral trade balance would automatically fail. That's because international trade is a system, not a series of summable individual country-by-country relationships. A country's trade balance is the difference between what it consumes and what it produces. In the U.S., we consume more than we make. Aggregate demand is greater than aggregate supply. So we end up importing the difference to satisfy that demand, and we have a trade deficit. China, on the other hand, produces more than it consumes. It sells its excess to us and the rest of the world. It has a trade surplus. To Donald Trump, the answer is to slap tariffs on Chinese-made goods. But that won't solve the problem, because we are the problem. As long as we demand more than we produce, the trade balance won't change. We will just buy more stuff from countries other than China. If China isn't the lowest cost supplier, someone else will be. Why won't we make more stuff here? We likely will, just not enough. Meanwhile, our other economic policies are working to worsen the trade deficit. The U.S. has a large and growing budget deficit, which we fund by selling debt. As the deficit rises, interest rates have to rise to attract buyers. That strengthens the dollar, which makes American exports more expensive and harder to sell. It makes imports cheaper. Tax cuts, meanwhile, give people more money to spend, increasing demand for those imports. We increase demand without increasing supply, and the trade deficit gets worse. Not even Donald Trump is above the law of supply and demand.
So why does the difference between exports and imports matter to a country that hasn't had a goods trade surplus since 1975? We asked Mary Lovely of the Peterson Institute.
We shouldn't care about the trade balance. The trade balance is an accounting number, and sometimes a country has a trade surplus, sometimes it has a trade deficit. What it means is it reflects how much you are spending relative to how much you're earning. And just like in your own private life, there are times when you should spend more than you earn. For example, the country of Norway discovered North Sea oil, and it did not want to depress the consumption of the current generation, the people alive at that time, to build up the investment necessary to exploit that new resource. And so they ran trade deficits as they borrowed from the rest of the world to begin to drill and to get this precious resource, from under the ocean. And lo and behold, now they run trade surpluses. So they invested the money wisely in an asset that played off for years to come. So the answer to is the trade deficit bad or good is really, why do you have one?
We like to buy. We're big consumers. We have the most open market. We have low tariffs, and it's actually been a benefit.
Fred Hochberg was president of the Export-Import Bank under President Obama and author of Trade is Not a Four-Letter Word. Like Mary Lovely, he questions all the emphasis on the balance of trade.
Yes, there are obviously some shortfalls, but we have the greatest array of products. You go to a supermarket, there are over 30,000 different products. So that's been a great benefit to our economy.
Even if it were important to address the trade balance, Lovely is not at all sure that the 60% tariffs on Chinese imports and 25% on imports from Mexico and Canada are the way to go.
There's a misunderstanding of thinking that tariffs, because they'll lower our imports, will change our trade deficit. So if President Trump goes ahead and put on tariffs, we would expect that the U.S. dollar will strengthen. That will make our exports less attractive to foreign customers, to buyers abroad who have to pay more for them. And so both imports and exports can shrink, and the balance could very well be unaffected. So it may have zero effect on the trade deficit. It could even increase the trade deficit. That is, if we don't handle the underlying drivers, which have to do with domestic saving and investment.
When the president-elect talks about the problem of the U.S. trade deficit, he consistently focuses on goods, not services, when much of U.S. strength is in the latter category. Hochberg says that means the trade balance numbers may be distorted.
We're the second largest exporter in the entire world. We're second only to China. And one of the things we excel in is service exports, whether it's media, like Bloomberg media, financial services, insurance, travel. Those are much harder to calculate and capture. So my hunch is our exports are somewhat understated as a result.
Beyond their effects on the trade balance, there's another aspect to tariffs that have attracted President-elect Trump, the prospect of raising revenue.
Why did we turn away from tariffs as a source of revenue? And the historical record shows us what folks were talking about 100 years ago. What they were talking about is that it was a tax on consumption, and it left earnings that were saved untaxed. So what you had was lower income people who save relatively small percentage or even zero of their income, really facing taxes on everything that they buy. Whereas rich people were only taxed on the small share of their income that they actually used to buy things.
Donald Trump is far from alone in thinking that the sort of across-the-board free trade approach taken in the past has done real damage to certain industries and workers in some parts of the country. The question is whether tariffs are the best way to address the issue, or whether a more selective approach is called for.
We have something called trade adjustment assistance. It's never been really fully funded to sort of support workers whose jobs have been compromised or lost due to trade to make sure that they can find other jobs and seek other employment. That needs to be far more robust than it's ever been.
To say that we may be misled by focusing too much on the trade deficit, or that imposing tariffs may not get us where we want to go, is not to say that the new President Trump's trade policies could not help the U.S. accomplish things it needs to get done.
Well, I think what he likes to do is one-on-one negotiations. He doesn't want them like the Trans-Pacific Partnership. And there's a talk he might want to do some other one-on-one trade deals that would include higher tariffs that they would impose on China to sort of stop the Chinese overproduction. And China is overproducing and exporting a lot of their goods because they want to keep people employed. That hurts other countries that are trying to increase their businesses, their manufacturing, or their agriculture.
In the end, maybe the most important point about the U.S. trade deficit is that it can distract us from its underlying cause, and a much bigger problem: how much the U.S. is borrowing from the rest of the world.
A trade surplus is the excess of your saving over investment. So that can change when your savings rate changes or when your investment rate changes. The U.S. has had very healthy investment, and that's good. Our saving, though, has gone down. So we have a relatively low savings rate comparing across countries. And part of that is due to low private savings, but also low government savings. So here we get back to the large federal budget deficit and evaluating whether you think that deficit is something that should be made smaller.
You know, what drives our economy? It's consumer spending, business investment, government spending, and a deficit, whether it's exports or our budget deficit. So that it's only one of four components. We need to up our exports. We probably need to have our budget in better alignment because we are spending a lot more than we're taking in. It's one of the things Scott Bessent, the incoming Treasury nominee, says he wants to work on. So we have to look at it in the totality. But it's easy to focus on the trade deficit because it's like foreign, and we don't have to talk about raising taxes.
Coming up, the U.S. is way behind in the efficiency of its ports. Does it matter? And what can be done about it? That's next on Wall Street Week. This is a story about American exceptionalism, but not necessarily the good kind.
The World Bank comes out with this list of the top 400 or 500. The USA ports are not hardly ever in the top 100.
That's Mario Cardera, CEO of the Port of Long Beach in California, America's second busiest port. It ranks number 9 in the world in level of activity, but number 373 in the list he refers to, the World Bank's annual Container Port Performance Index, which measures efficiency based on how long a ship stays in port. That index for 2023 ranked Yangshan, China, Salalah, Oman, and Cartagena, Colombia first, second, and third. The only U.S. ports that made the top 100 were Philadelphia at 55 and New York, New Jersey at number 92. Of the bottom 50 ports listed, 6 of them are in the U.S., making America's shipping infrastructure exceptional in the length of its delays. Turlock Mooney is the global head of port intelligence and analytics at S&P Global, which partnered with the World Bank to create the efficiency ranking.
Ports are critical to fluid supply chains. Efficient ports are extremely necessary to keep goods flowing smoothly. Efficient ports are actually catalysts for development. They attract investment, they attract logistics infrastructure, and they ultimately help to drive growth. Conversely, inefficient ports can have the opposite effect.
Time, as they say, is money. And when it comes to United States imports, it can be a lot of money, given the importance of consumers, which makes ports like Long Beach an indicator of the strength of the economy overall.
You have a great economy, and the American consumer is spending. In terms of Port of Long Beach, our numbers lately have been historic. So we're approximating now, after 9 months, we're up in terms of TEU volume. We're up about 19% over and above last year's number.
To handle all that volume, ports like Cordero's Long Beach have been changing the way they do business, trying to make sure that they're as efficient as they can be, improving that low ranking in the World Bank Index. And some of that requires automation.
The research right now points to the fact that automation clearly is a cost reduction policy. For the Port of Long Beach, we're interested in productivity. As a global community, we've entered the fourth industrial revolution, so to speak, and that is the coming of robotics, automation. If you go back to a report that McKinsey issued back in 2017, they predicted that by 2030, we would lose 2/3 of American jobs as we know. For every robot that you put in place, there's 6 jobs that are eliminated. So I think for the Port of Long Beach, how we navigate that issue, as a public port, we have to consider all factors. And I think what we've been successful at, and when we do talk about automation, or in the case of Long Beach Container Terminal semi-automation, we have that discussion as a stakeholder group, a collaborative effort.
Automation at seaports is not an all or nothing proposition. Loading and offloading ships and moving cargo from one form of transportation to another involves many complex steps, some of which are more readily automated than others, and some of which don't lend themselves to automation at all, given current technology.
The main benefit of automation, and the reason that it is the future, and the reason that you see the most efficient ports in the world automating operations more and more, is that it sits very well with digitization. So it's an important part of the technical foundation for interoperable data, sharing of data between different stakeholders, sharing of good quality data, so that action can be taken where necessary to drive efficiency and improve efficiency of port operations.
automation is far from the only way that ports like Long Beach are seeking to improve efficiency. Indeed, it may not even be the best way. A better approach may be to get more productivity from the system the way it's now configured, particularly by extending the hours the port operates.
One of the things that I was very vocal about is how we move to 24/7 operations. Now, we're not working 24 hours a day, 7 days a week anytime soon. Imagine if you told the American consumer you can only fly during the week and the airports were closed on weekends, or you can only fly between the hours of 8 a.m. and 6 p.m. I mean, imagine what the airport bottleneck would be like. So I think the same emphasis needs to be put in terms of how we move cart.
Another route to improved efficiency is rail. One train can carry 750 trucks worth of cargo. And earlier this year, Long Beach broke ground on a $1.5 billion expansion of its rail yard that will triple the amount of cargo it can handle annually. John Gabriel is Group President for Consumer Products at BNSF, one of the two railroads servicing Long Beach.
October of 2024 was the biggest single month moving intermodal that we've had as BNSF Railway. Tying that back to the ports, this year it's on a record pace for the most ship-to-train movements that we've done. It's the fastest we've ever gotten to 1 million containers loaded onto trains and departed out of the ports of LA and Long Beach. And I would certainly say that's a testament to, the investments we've made. Again, we've invested in tracks, facilities, more than $2.5 billion over the last 5 years. I think it's a testament to the collaboration we have with the ports of LA and Long Beach and the investments they've made. That's so important right now. Right now, we're handling more volume than we were post-supply chain crisis, where we saw the huge uptick in consumer demand, post-pandemic. And we're doing it about 50% faster from ship to train. And ultimately, the ship to end destination across our intermodal network is about 75% faster than it was from a transit perspective back in 2022. And really, I would say the entire supply chain and all stakeholders have really stepped up. And it's really been a great demonstration of capacity and supply chain resiliency for all the goods moving through the West Coast.
Containers in Rotterdam are only 33% of the total cargo throughput. The major cargo, nearly 50%, is liquid bulk.
Half a world away, Hanna Stelzel is working on maximizing efficiency in Rotterdam, where she's the director of containers. It's the world's 10th busiest port and ranks 91st in the World Bank's Efficiency Index. As with Long Beach, Rotterdam is facing increasing demand.
We're expanding our container capacity. We do know from research that the container business in Europe will be growing. Actually, it will be growing all over the world. That has to do with containerization, that has to do with a growing middle class. And in order to prepare for that growth and to participate in that growth, we had decided to invest into our infrastructure.
Rotterdam is a leading port in a new system called Gemini, involving shipping companies Hapag-Lloyd and Maersk.
The trends that we see is that transshipment volumes are growing. That has to do, for example, with the fact that we have hub and spoke concepts that are being introduced. Maersk, together with Hapag-Lloyd, introduced the Gemini concept.
The Gemini project features a series of hub ports around the world that handle the bulk of the cargo. Containers are then immediately loaded onto smaller ships destined for spoke ports dotted all over the world. Central to the project in Rotterdam is APM, which bills itself as the most advanced, most fully automated terminal in the world. Its CEO is Harold Kunst.
The Gemini approach is different than the traditional shipping line approach we took for many decades. With the hub structure integrated into the network of the 5 hubs in the east-west approach from the trade, is that we are able to enable the ships to be 9 days earlier from Far East into Europe.
Ports like Rotterdam in Europe and Long Beach in California are seeing greater demand than ever for cargo handling and are investing and innovating to keep up with what's coming their way. So why is it that they still lag so far behind their counterparts in Asia, in the Middle East, and even in Latin America? Why is it that it takes 2 or 3 times as long to move a container at a U.S. port than it does in China? It turns out that there are several reasons. First and most basic is that 24/7 schedule that Cordero is pushing for at Long Beach, but that hasn't yet been accomplished.
After 9 months in the year 2024, because of expanded hours of operation, which commenced with the 24/7 conversation. Again, are we 24/7 today? No. Have we taken incremental steps to expand operation hours? Yes. That's a big reason why we don't have congestion and bottlenecks at the Port of Long Beach, because our terminals have been able to work with us in making sure that we use night gates, we use early morning gates, we use weekend hours in times that we have historic volume, which is what we have done. So I think, again, we'll get there.
Even if Long Beach were up and running all the time, it would be very difficult for it to approach the efficiency level of some major ports because of where it fits in the supply chain. Goods coming into Singapore or Oman, for example, are transferred from one ship to another, rather than being moved overland by train or truck for distribution in the United States.
We're not a transshipment port. I mean, some of the larger ports that you look at, for example, Singapore, they are a transshipment port. They always have been and they always will.
And finally, there is the question of automation, something that others make more use of than the US. But as much as automation promises to be an answer to so many prayers for greater efficiency, first, it comes with a price, quite literally, in the investment it requires, with the associated questions of where the capital will come from and whether it will earn the return on investment normally required.
There's about 1,200 legitimate container terminals throughout the world. Only about 4% are automated. So the challenge with any type of transformation of technology is a costly endeavor. So from a private sector perspective, what's the return on investment? I think that question is probably going to be more challenging moving forward, because obviously none of this happens unless there's private sector investment.
In the United States, it's not just a question of the capital investment and return. Automation also has potentially substantial effects on employment, which led 47,000 members of the Longshoremen's Union to go on a 3-day strike in U.S. ports on the eastern seaboard and Gulf Coast in October, something Cordero on the West Coast is very aware of.
For a port like Long Beach, who are public ports, we need to take into account the social impacts that has. I think that at the Port of Long Beach, we're proud about the footprint that we have in terms of job production. 535,000 at the local level. At the state level, 704,000 plus jobs directly and indirectly as a result of the Port of Long Beach. And at a national level, the number's like 2.6 million. So we're talking earlier about the great economy that we have, our dependency of our GDP based on consumer spending. Robots don't spend money, consumers do. So that's the conversation that I haven't really heard amplified, because for us, it's very important to keep labor in place. Because hypothetically, you eliminate labor, what are you doing to the economy and spending in terms of consumer spending?
And that story will be an important part of the larger story of American exceptionalism and whether the U.S. can remain the dominant economic force in an increasingly competitive world. Coming up, why families from Las Vegas to Vancouver can't afford to buy a house. If you can buy the house, why you may not be able to afford to insure it, particularly if you live in Florida or in California. That's next on Wall Street Week. This is a story about risk, how much we are willing to pay to protect against the risk of losing something we value. It's a story that always begins when something goes very wrong.
This is where we designated the water levels for Helene.
Glenn Scarpa and his wife own Scarpa's Coastal Restaurant in Boca Grande, a small island town in Florida.
We cut everything around the whole restaurant at 2 feet, to get all the wet stuff and insulation out. 10, 12 days later, we got this one. And then we walked in here and said, oh,
December 1st marks the end of the Atlantic hurricane season, and it's been expensive and deadly. In Florida alone, 3 hurricanes made landfall in 2024, tying the highest years on record. And although the toll is still being added up, we now know the storms sweeping through the United States took more than 300 lives and cost over $190 billion across the country. That price tag makes it the 3rd costliest season in U.S. history. Scarpa, like millions of other Floridians, turns to insurance to help protect against losses from extreme weather. As the insured, he's the first step in a food chain of risk that starts with individuals or businesses, goes up to insurers, then to reinsurers, and ultimately can hit investors or even taxpayers. With each step, the risk is calculated, changed, repackaged, spread around. But one thing we know for certain, it never goes away. As risk increases in the United States and costs to insurers stack up, insurance premiums have also been on the rise. Are we at an historical high here in the cost of insuring a home?
I'd say yes. The average cost for Florida homeowners policy is about $6,000.
Jerry Theodorou is director of the Finance, Insurance, and Trade Policy Program at R Street Institute, a DC-based think tank that promotes free markets.
In the insurance world, in rate making and pricing, the rate follows the risk. The risk magnitude has increased, so because the risk has increased, the losses have increased, and insurers are playing catch up and raising prices. And there are some unique factors for Florida which differentiate it from the rest of the country.
It turns out that extreme weather is only one of those unique factors. Insurance has also gone up because of people moving to the state and building more expensive houses in risky locations.
There's more built-up value. Florida had a population of 2.2 million in 1946, and it's now 22 million. It increased 10 times. So there's a lot more built-in value in Florida that's available there to be hit by a hurricane and be destroyed. So we've got climate change, we've got the built-up environment, which has grown. There's more real estate out there to be destroyed, and you have the inflation in these prices. So it's like a trifecta.
A lot of circumstances hit at the same time.
One step up the ladder of risk, from insured to insurer, Tim Serio is CEO of Citizens Property Insurance Corporation.
You had, COVID and post-COVID, a lot of folks flocked to Florida. You had property values skyrocket, which, you could be very happy that your home was worth more, but if it costs a lot more to replace it, you're going to be paying more in insurance. You had inflation over the last several years, which drove up construction costs, cost to replace your home.
It's not just Florida that's been hit by higher insurance costs recently. Across the country, insurance prices have surged over the past 2 years. Since the beginning of 2023, the cost of homeowners insurance nationwide has climbed over 21%, while CPI rose just 5%. The price of some commercial insurance is up nearly 15% over the same period. Theodorou says the greatest problems facing insurance markets have been man-made. Companies leave states like Florida and California not because they can't price climate risk, but because they know the risk, and state laws and litigation won't always let them keep up with it.
If they're underpricing, they're not going to have a 6% profit margin, which is the going rate for insurance companies. Insurance companies are not fat, rich organizations. So that's why you have this seeming exodus from California.
This problem of insurance companies leaving the state gave rise to Serio's Citizens Property Insurance Company.
Citizens is the state-created insurer of last resort. The idea is that we exist to help the people of Florida find insurance when they really have no options. Maybe it's because of maybe they're a higher risk, not necessarily because they've done anything wrong, but the characteristics of their home.
Today, the last resort has become the only one for many who live in Florida. Citizens is the largest insurance firm in the state.
Our rates were artificially suppressed, and we became probably on the whole the cheapest in the state of Florida, which caused us to grow exponentially, and that's not a good thing. There has been pretty much bipartisan agreement that a very large Citizens is not healthy overall for Florida, because if we grow too large and there's a storm or a series of storms and we can't pay our claims, the good news for our policyholders is their claims will always be paid because we have the requirement to levy a surcharge on citizens' policyholders. And if that doesn't suffice to pay claims, then it's an assessment on policyholders and non-policyholders alike to make sure claims are paid.
Individuals may be struggling to pay their premiums, and states may be struggling to keep premiums within reason. But it's not because the insurance companies are pocketing big profits. Profit margins for the S&P 500 insurance sector have climbed over the last few years, but to levels that are far from shocking, peaking around 12% this year before sliding to 7% in November. Compare that to 2024 highs of around 16% for the financial industry and over 24% for big tech. One factor constraining profit margins for insurers, beyond the claims they're paying out, has been the rising cost of insurance that they themselves have to pay. One more step up the ladder of risk.
Swiss Re is a global reinsurance company, and our clients are insurance companies. We partner with insurance companies to protect their balance sheets.
Monica Ningen is CEO of U.S. Property and Casualty Reinsurance at Swiss Re, one of the largest reinsurers in the world.
When it comes to reinsurance rates, there is an impact from climate change, but it's relatively small. The other factors being economic inflation, wage inflation, inflation of construction plays a big factor, especially in the last few years. But you also have things like urbanization and people moving into areas that are more susceptible to catastrophes.
Each of those factors helped push reinsurance rates higher every year since 2017, with an especially sharp rise in 2023. But early figures for this year suggest the trend might finally be leveling off. And even though we're closing the books on one of the worst hurricane seasons on record, signs are that this year's natural catastrophes haven't led to financial ones.
It's a chain there that spreads the risk around so that when you have a catastrophic event like Hurricane Helene, it didn't hurt the third quarter earnings. A remarkable thing. It happened at the end of September. Helene went up to North Carolina, but the insurance companies, they just reported the third quarter earnings the last few weeks, and they were pretty upbeat, didn't lose a lot because very sound, prudent use of reinsurance. And there's also private investors that want a piece of the action in the form of insurance-linked securities, also called catastrophe bonds. So there's a lot of capital. So whereas people are talking about, oh, this is going to be a $40 billion or $50 billion event, insurance companies can handle that. They're built to do that. That's what they do. So we're seeing some positive, some tailwinds that are really worth watching.
Despite all the factors driving insurance costs up, those who know the industry well see cause for hope, at least in Florida, where the government has worked to reduce lawsuits that have cost a good deal to insurance companies.
The good news is that about a year and a half ago, the governor of Florida signed into law some comprehensive tort reforms that really cut the feet out or cut the legs off from some of these excesses of litigation. After the tort reforms went into effect last year in March, we've seen that the number of lawsuits in the first 3 quarters of the year, because we just saw the Q3 numbers, went down by 24%.
We hit 1.41 million policies in October of 2023. We're a little over 1 million now. We should end the year at around a little over 900,000 policies. That means that private carriers are coming in, they're taking policies out of citizens, they're willing to write more risk. So, that is evidence that the market's getting healthier.
Recently, one of the publicly traded insurance companies in Florida said that we're not doing more rate increases. So it appears as if the insurance industry has caught up with the loss magnitude.
Whether or not lower insurance rates find their way to businesses and homeowners in Florida and across the country in the short term, we do know that climate risk and development in risky areas isn't going away. Monica Ningen says what happens next will come down in part to those of us at the bottom of the chain.
So when you look to the future, I think there's a few things that will change. I think that consumers will start to better understand their own risk exposure and what their own resiliency looks like. as events impact our lives every day, whether it's snow impacting, your commute to work, or it's a flood that's imposing on you returning back to your home, consumers are being more aware than they ever have been on the risks that their homes face.
Back in Boca Grande, Glenn Scarpa says he's very aware of the risk of another hurricane, but he's hoping to manage with a little bit of luck and insurance.
I mean, you got to anticipate that, it's probably going to happen again. Who knows? It could happen next year, could be 30 years, it could be 100 years, but it's going to happen again at some point.
Having a business on the island, Scarpa says, is still worth the risk. But after moving there 5 years ago and seeing the destruction to both his restaurant and his home, he's decided to sell his condo and move inland onto greener, and he hopes drier, pastures. That does it for us on Wall Street Week. I'm David Westin. We'll see you again next week for more stories of capitalism.